Hey everyone, welcome back for another deep dive. Today we're tackling a question I'm sure many of you have grappled with. Should you prioritize paying off your mortgage as quickly as possible, or consider investing that money instead? It's a tough one, right? You want to be free of that debt, but there's that little voice saying, hey, maybe there's a smarter way to use those funds.
It's a question I get asked a lot. And honestly, the answer isn't always obvious. It's not as simple as just wanting to be debt-free, especially these days when the potential returns you see bandied about for certain investments often dwarf the interest rates on mortgages.
Okay, so we're diving into the ring with aggressive amortization in one corner and a potentially more strategic investment approach in the other. And you know me, love me some strategy. One of the things that really struck me from the research we looked at was this whole idea of mortgages being front-loaded with interest. Like those first few years of payments are basically a gift to the bank.
Haha, that's one way to look at it. So the way it works with most mortgages, particularly those with longer terms, is they use something called the declining balance method to calculate the interest. So yeah, in those early years, you end up paying a hefty chunk of change just on the interest and barely making a dent in the principal.
Yeah, and it's kind of shocking when you actually see it laid out like in that Bankanter chart we've got. Seeing that visual really drives home how much those interest payments decrease over the life of the loan.
It's a powerful illustration. For a real-world example, let's say you have a $300,000 mortgage, right? In those initial years, a big chunk of your monthly payment, maybe something like 1,500, is just going straight to interest.
Hmm.
But as you move through the loan, that ratio starts to shift dramatically. More starts going towards the principal and less towards that pesky interest.
So the further you get into the mortgage, basically, the more of your money is actually going toward paying down what you owe.
Exactly. And that brings up an interesting question, doesn't it? Does it always make the most financial sense to prioritize paying off that principal early on, or could you potentially put that money to work better elsewhere?
Which I'm guessing is where the whole idea of opportunity cost comes in. Like, say I'm laser focused on paying down my 2.5% interest rate. Am I potentially missing out on like double or even triple that by investing the money instead?
That's the heart of it. And it's not even just about chasing higher returns. It's about recognizing that every financial decision has these ripple effects.
Okay, now you've got me really intrigued. Tell me more about these ripple effects.
Think about it like this. Every euro you're putting towards your mortgage early on, it's a euro that's not invested in, well, anything else, really. Assets that could be growing, appreciating. That's opportunity cost in action.
Right, okay. So instead of throwing extra money at my house, I could be taking that same amount and putting it into, say, the stock market and potentially seeing much higher returns.
Exactly. And while it's true that past performance doesn't guarantee what's going to happen in the future, history does show us that long-term investments, particularly in things like index funds, have the potential to really outpace those, shall we say, modest mortgage interest rates.
And the source material we're looking at today is specifically mentioned index funds, calling out the S&P 500 and the MSCI world. What is it about these specific funds that make them so, I don't know, appealing in this context?
Well, for one, they give you instant diversification. When you invest in something like the S&P 500, you're essentially tracking the performance of 500 of the biggest, the most well-established U.S. companies, so it gives you a really broad slice of the market. And then the MSCI world, it takes that even further, tracking thousands of companies across the globe.
Okay, so instead of putting all your eggs in one basket, you're spreading your investment across, what, hundreds, thousands of companies?
Precisely. And by diversifying like this, you're doing a lot to mitigate risk, right? And then when you look at the historical returns for these indexes, which are source pegged at about 8% per year over the long term, you start to see why this whole idea of opportunity cost is so crucial to factor in.
Yeah, that's a good point. So, okay, let's just like play with some numbers for a sec. Using that 300 monthly payment we talked about before, if I'm putting that much extra towards my mortgage every month, sure, I'm chipping away at what I owe, but it's slow and steady, right? But if I took that same 300 euro and put it into an index fund instead, aiming for that, let's say 8% annual growth, even with the ups and downs, we could be talking, what, maybe 180,000 after 20 years versus the 72,000 I would put in directly.
You're getting it. That's the beauty of compounding. It's not just the money you're putting in, it's about those returns generating even more returns year after year.
Okay, I have to admit that is a pretty compelling argument.
hmm
But I have to say, even knowing all that, there's still a part of me that just, I don't know, craves that feeling of being totally debt-free. Like knowing my home is really, truly mine. No more monthly payments hanging over my head.
I get it. I really do. It's a powerful psychological thing. But here's where the conversation gets even more interesting. Remember we mentioned liquidity earlier.
Liquidity, right. Being able to access your money when you actually need to use it.
And that's exactly where having a diversified investment portfolio, which could totally include those index funds we talked about, can actually give you even more peace of mind than just relentlessly paying down your mortgage.
So wait, it's not just about higher returns. It's also about having options, like a safety net.
You got it. Think about it. What happens if you suddenly have a big, unexpected expense? Medical bills, you need a new roof, you finally get to take that dream vacation. If all your money is tied up in your house, getting access to it might mean taking on even more debt. And who knows what kind of interest rate you'd be getting then?
Ah, yeah, that would definitely take the fun out of that dream trip.
Yeah.
So by investing some of my money, it's like I'm creating this financial cushion for, life's little surprises.
Yeah.
And I can do that without having to give up on my long-term financial goals.
Exactly. It's all about striking that balance, building equity in your home, sure, but also creating a strong investment portfolio that gives you options and flexibility down the line.
Okay, so basically what we've established is there's no one right answer here. It really depends on your own situation, how much risk you're comfortable with, and what your personal financial goals are. Which is a perfect time to bring up those 3 key questions from the source material, right?
Absolutely. Those questions are there to help you cut through all the noise and figure out what strategy is going to work best for you individually. And we'll start with the first big one, your mortgage interest rate.
Yeah, that interest rate, it's like the key to the castle or something. And I can definitely see how having a higher interest rate would make that aggressive amortization strategy, way more tempting. Especially early on when you're still battling all that front-loaded interest we were talking about.
Absolutely. If you've got a higher interest rate, you're essentially losing more of your hard-earned money to the bank. So yeah, getting rid of that debt as quickly as possible, it can be a smart move in that scenario, especially if you're someone who's a bit more risk-averse or you really prioritize that psychological win of, being debt-free, like sooner rather than later.
Yeah, for sure. And then question number 2 from our trusty source material. Where are you in the whole mortgage timeline thing? Like, is this a brand spanking new mortgage, or are you getting close to that finish line?
Right, because that matters too. Early on in the mortgage game, you've still got a hefty principal balance hanging over your head, right? Which means a bigger chunk of your payments are still being eaten up by interest. But as you get closer to paying it off, well, those payments start to pack a lot more punch when it comes to actually reducing what you owe.
So if you're already well into your mortgage, the need to, aggressively pay it off isn't quite as, urgent.
Exactly. You're already naturally shifting to a point where more of your payment is going towards that principal. Which leads us to the third question, and this one might be the trickiest to answer. How much does getting that mortgage paid off early, truly matter to you personally?
Yeah, that's a big one, right? Because at the end of the day, it's not just about the numbers, is it? It's about that feeling of freedom, that security that comes with knowing you own your home, free and clear.
Yeah.
And how do you even put a price tag on peace of mind like that?
Exactly. For some people, that feeling of liberation, of knowing their home is truly theirs, it's worth making some financial trade-offs for. And honestly, that's completely valid. I mean, they don't call it personal finance for nothing, right?
True that. Okay, so if I had to, sum it all up, I'd say we've learned there's no magical formula, no single right answer for everyone. It comes down to knowing your interest rate, figuring out where you're at in your mortgage journey, and then weighing those factors against your own personal goals and, how much risk you can stomach.
You nailed it. It's about making informed decisions that work for your unique situation, not just blindly following some, predetermined path.
Right on. Which brings us to that thought-provoking little nugget from the source material, the idea that maybe, just maybe, focusing on smart investments instead of just going all in on aggressive amortization could actually help you pay off that mortgage faster in the long run.
It's a fascinating concept, and while there are no guarantees, obviously, it speaks to the power of compound interest and the potential to really build wealth over time through strategic investing.
So just to be sure I'm following, you're saying by diversifying my investments, taking advantage of those, growth opportunities out there, I could potentially, accelerate my journey towards not just financial freedom overall, but mortgage freedom as well.
Now you're getting it. It really challenges that traditional way of thinking, where debt, even mortgage debt, is this big bad thing that has to be eliminated as quickly as humanly possible.
Wow, we really did flip the script on that one. This whole deep dive has honestly given me a ton to think about. I came in here thinking it was going to be this simple amortize or invest situation, but wow, there's so much more to it.
And that's what makes personal finance so interesting, right? It's about understanding the why behind your choices, finding strategies that empower you to achieve your own unique financial goals.
Absolutely. So I guess the takeaway here is don't be afraid to ask those tough questions, break out the calculator, and really look at things from every angle. You might be amazed at what you discover when you challenge those conventional wisdom kind of things. Who knows? Maybe you'll even find a path to financial freedom that goes way beyond just being debt-free, one that lets you build wealth, chase those dreams, and just live life on your own terms. And on that note, we're going to wrap up this deep dive. Be sure to check out our show notes for links to all that great source material we talked about and some other resources to keep you exploring the awesome world of personal finance. Until next time, keep learning, keep growing, and keep diving deep.